Okay.
Thanks. Welcome again, everybody. We're pleased to welcome Dr. Dean Foreman from the American Petroleum Institute. He is the chief economist and an expert in economics and markets for oil, natural gas, and power, with more than 2 decades of industry experience, including ExxonMobil, Talisman Energy, Sasol, and Saudi Aramco in forecasting and market analysis, corporate strategic planning, and finance risk management. He has a Ph.D. in economics from the University of Florida and is known for knowledge of energy markets, applying advanced analytics to assess risk in markets, and clearly and effectively communicating with management, policymakers, and the media. We're pleased to have him today, and we'd like to especially thank Todd Shelton for connecting us to this great speaker. We'll turn it over to you.
Thanks, Gwen. Thanks, Dan. And thank you all for having me. Just to set time frame, how long would you like me to go this morning before we, I think I see what we're scheduled for, but if it's about 20 or 30 minutes of talking and maybe Q&A, I'd like this to be conversational, and I can either take you through a plethora of slides or we can kind of chat through the main things. Either way, I'll start by sharing screen here.
Dean, whatever you prefer is fine.
Thank you.
You know, whatever works best. I don't, you know, do you want questions throughout the presentation, or would you rather have them at the end?
I'd rather have you ask and this be conversational. So I'll pause at various points. Please feel free to interrupt. You know API, you know us as a standard setting organization for 100 years. You know us as an advocacy organization for the industry. A lot of people don't realize that we're also a primary data source, and we're surveying up to 90% of the industry each week. So together, we put the weekly data out a day ahead of EIA. We make freely available on our website a monthly statistical report that has supply, demand, trade, inventories of crude oil, natural gas liquids, every major refined product, 2 months ahead of EIA. And we just put that out last Friday. And then what I'm going to share with you here is putting those data in context of the broader economy, oil markets in the US globally, natural gas markets in the US and globally, as well as some petrochemical feedstocks. So I'm going to take you around, a bit of a tour of the industry and a tour of the world. And please feel free to jump in, anytime either something's not clear, you have questions, or you'd like to go a different direction. The things, any of us monitoring the headlines right now, it begins and ends with the economy, and people are really concerned about whether there'll be a recession. And if there's one thing that's been the downdraft, in my view, the most downward impact to oil prices since last summer, it's been the Fed rate increases. So forcing financial markets to price in a recession, slower growth expectations for this and next year. And as that's happened, you got a super strong US dollar currency exchange rate versus other currencies. It's in the way it trades, risk on, risk off. So not just oil, but a lot of other commodities went down in price over that period. And when we look forward now, and you just saw the GDP report that came out last week, the numbers through the fourth quarter look reasonably solid. And it's now in the Bloomberg consensus, IMF and World Bank expectations for stall speed in the US and Europe, really starting this quarter and then maybe a contraction through the second and third quarters. At least that's the Bloomberg consensus view right now. So that's where we are, but it's not the global view. And I will unpack some of this for you in the slides of showing in particular where China and emerging markets are coming from. Another thing that the United Nations celebrated in mid-November was the milestone of 8 billion people on the planet. This, it has really, it's a double-edged sword in the sense that as the population has continued to grow and it adds to the working age population, adds to the labor supply for the world, that's been an enduring source of economic growth and is expected to continue. At the same time, though, the challenges that we've had post-pandemic for food and energy systems to feed and supply energy to 8 billion people on a planet have been made possible by globalization, by productivity gains. And a lot of these things are under stress right now. The shortage of natural gas globally isn't generally appreciated for what it means for nitrogen-based fertilizers, for therefore food supplies around the world. And in the US, we're a relatively wealthy country. We will tend from a market perspective to get the supplies that we need. But keep in mind that the US, China, Ukraine, Russia have been major producers of agricultural goods and exporters of them. And now we have both a conflict with Russia, Ukraine that's affecting that, as well as higher prices and broad price inflation that's escalated. And this is one of the uncertainties. So I'm going to show you an economic view that basically says the world does pretty well here, at least in the overall view. But one of the potential scenarios and potholes is what happens with debt in emerging markets, what happens if you don't have adequate food supplies in emerging markets. These are the things that we can't really predict, but they're on the radar as possibilities. Now, from an oil market perspective, oil demand globally really does go hand in hand with the economy. I'll show this to you in a few slides, but to put it in perspective, our latest monthly data, our estimates put out last Friday for the United States in December, 20.5 million barrels per day. For the year as a whole in 2022 by API estimates, 2.4% growth of petroleum demand in the US compared with 2021. That's a strong year. So not recessionary like growth in terms of petroleum demand in what we've seen this last year. On a global level, the US Energy Information Administration, their expectations here are over 100 million barrels per day of demand globally for oil this year, growing to a record over 102 million barrels per day in 2024. So despite diminished economic growth expectations, where everybody has priced in recessionary-like growth for this year in developed economies, oil demand is expected to grow. The amount of the growth, by the way, in EIA's expectation, the Energy Information Administration, is 1.1 million barrels per day of growth this year. In the International Energy Agencies, this is the Paris-based IEA, in their view, it's 1.9 million barrels per day of growth. And you might ask, well, how could IEA be almost twice as much as EIA? You know, can't you forecast it with more precision than that? And the answer is that they have varied expectations about economic growth and the recovery of China later this year. And sitting in Europe, the IEA is more bullish on oil demand also because they see a global shortage continuing for natural gas, meaning that emerging markets around the world burn more natural gas, diesel generators going to get electricity. So if that continues, and that's somewhat contingent on what happens with Russia, Ukraine, other supplies developing, it really does play into the amount of oil demand, both from an economic perspective and a fuel substitution perspective. Now, where's that supply going to come from? And I'll show you this in detail as well. In EIA's view, about 1 million barrels per day of supply growth should come from the United States this year. We'll look at the productivity trends, but the punchline here is that drilling is still down compared to where it was pre-pandemic in the US and globally for oil. The productivity estimates by EIA's estimates for the oil patch are down about 20% year on year for the United States. So in our primary data and what we see, it's been very difficult for crude oil supply to break out. It's been stuck at or above, slightly above in the last couple of weeks, 12 million barrels per day. And that compares with a high water mark in late 2019 and early 2020 of around 13 million barrels per day. So we're down domestic crude oil production of roughly 1 million barrels per day. What did we release from the US Strategic Petroleum Reserve over the last half of the year? 1 million barrels per day for 6 months, 180 million barrels. For the year, we drew the SPR down by more than a third. We now have the lowest strategic petroleum reserves in almost 40 years, so the lowest since 1983. And if we're comparing our petroleum consumption as a nation back to 1983, it's more than a third higher than it was back then. So the open question for policymakers is, in this geopolitical environment, why are you comfortable with the lowest crude reserves in 40 years? I mean, you don't have to go back much further than that to realize that was the genesis of the SPR. If you go back into the 1970s with the Arab oil embargo, the potential for a disruption is why we have the SPR. So we're kind of back to ground zero on this. As far as other sources, we'll talk about the global sources, but in the US, there's a side-by-side comparison with natural gas. I'll highlight for you through the course of this presentation some things that are really relevant to Ohio as well. But keep in mind that natural gas production, if we went back to the third quarter last year, the shoulder season right before the winter, we saw natural gas prices domestically spike as high as $10 per million BTU at Henry Hub. Today, they're sitting, closer to $3 per million BTU. And what happened was within 6 to 8 weeks, we saw the drilling activity go from below pre-pandemic levels to blowing past it. It's currently over 20% higher than it was at the same point in December 2019, before the pandemic. We saw the production levels for natural gas reach all-time highs. We've seen the extraction of natural gas liquids from that stream reach all-time highs. And all this activity is accelerated despite the same workforce and supply chain and financial and energy policy headwinds that have affected oil. So why is oil still down 1 million barrels per day, but natural gas is killing it? It's really two reasons. And unfortunately, it's not Appalachian gas that's really moving ahead here. In Ohio, you're still, compared with early 2019, down basically 3 rigs, gas rigs from where you were. Yeah, it's Texas and Louisiana that have just been killing it. Louisiana in particular has led the nation in gas growth this last year. The Permian Basin with associated gas in Texas is right second after that. So good business environments, great infrastructure, good proximity, everything has worked. Now, how long they can carry that isn't altogether clear, but it's been relatively easy for 2 states, 150 rigs plus or minus running for gas nationwide. For oil, it takes 4 times more capital and rigs, 600 compared to 150. And for oil, it takes a proverbial village of states. It's not just 2 states that can carry the water. So the Texas Permian Basin's been doing really well. It's at record highs in terms of production. But if we go across the border into New Mexico, not so much. They're still below pre-pandemic levels in terms of drilling. Well, what's happening in New Mexico? They, along with other states, are affected by this federal moratorium of new leasing on federal lands. In Colorado, very stringent state regulations, very difficult for the industry to get siting approved and permitting. It's really just killing the industry in terms of drilling activity. They're still well down below pre-pandemic levels. So literally taking a powder in Colorado. Wyoming and North Dakota also, affected by the federal moratorium on leasing on new lands, infrastructure issues as well. These things have played out where you've got 4 states that were important to the shale revolution that are now trailing their pre-pandemic levels. So this is critical, because if we want to recover 1 million barrels per day of oil production, as the EIA projects for this year, it's not clear where it's going to come from. And the drilling activity, while it's gone up, it's working against the headwinds and productivity that I just mentioned. This has caused the International Energy Agency, the IEA, Saudi Arabia, and OPEC, all 3 recently, to come out and say they don't think that the drilling investment and spare capacity for this year is sufficient to meet global demand this year, especially not record demand by the end of the year and going into 2024. So it's evident that we've had a global shortage of natural gas. It's clear in the prices, the premiums of international prices above US prices. A relatively warm winter has helped. We have masked over this shortage for oil that's clear in the data, but we've masked it by releasing government controlled or strategic petroleum reserves. And it's not just the US, by the way. The US in the last half of the year put out 1 million barrels per day out of the SPR, but coaxed other IEA, International Energy Agency member countries, to release another 300,000 to 400,000 barrels per day last year. So that's basically almost 1.5 million barrels per day, or 1.5% of global supply, that was just coming out of government controlled reserves last year. Much of this, honestly, was just a sheer effort to try to lower gasoline prices in advance of the midterm elections that came up in November. And now, with the lowest reserves in 40 years, against this geopolitical environment, we really don't have much margin for error going through things. So this year is critical. Once we get past 2 more Fed fund expected rate increases this quarter, the consensus expectation is 25 basis points this and next month. Once the Fed gets into neutral, if China recovers as expected and the global economy recovers with these demand estimates per the consensus in official agency views, it means the market is short in a really clear way here. We can't, for antitrust reasons, predict prices or talk about that, but in terms of the fundamentals, it's clear, and this is what the official forecasts are saying if you peel back the onion and really read them for what they are. So with that, I'm going to start to delve into investment and drilling activity, take you through the market dynamics. Any questions at this point before I proceed?
Dean, I just had a comment. I'd encourage the group to look up the presentation that was provided yesterday through the university through the Bird Polar Climate Research Center by Ian Sheldon. And it was titled, "How Do We Feed the World?" And it echoes what he's sharing on food demand, consumption, the gap between consumption and yield, and the expected growth in that gap growing between now and 2050. Some pretty eye-opening information in both of these presentations in 2 days.
No, thank you. And along those lines, because there's not a slide on this, I'm going to throw in a tidbit. I work a lot with the American Farm Bureau Federation here in DC, and it varies by crop. But if you don't have a nitrogen-based, natural gas-based fertilizer, and instead are using an organic fertilizer for a crop like corn sitting there in Ohio, you lose 40 to 60% of your crop yield using the organic fertilizer. This is endemic, and for 1 year, if you do crop rotation between, say, soy and corn, you can make it work and bridge it for a year, but eventually you have to have the fertilizer to not lose the crop yield. And this is a global problem. So it is pent up, it varies by crop, but you see basically in a context with broad price inflation, what we're looking at, it will be a severe challenge. So I'm going to hit these highlights quickly. I appreciate your conversation earlier. It was good to listen in because I can tell that you've got a detail orientation plus a lot of industry knowledge across the value chain. We track at API investment across the entire industry, both as a flow, as shown on the left here, and a stock or backlog of projects in the United States. The flow is really a global measure because many of these are global integrated companies, shown in the darker green, but the green shades here are either the upstream resource development dedicated companies in the United States or the global integrated ones. And the vast majority of the capital, and it's not just the downstream and midstream, pipeline export facilities, refineries, that is big capital, billions of dollars at a time. It's just that the drilling programs and the requirements for the upstream dwarf that and are so large globally by comparison. And you see it here, right? So the latest quarter, if we're putting a glass half full spin on it, 58 billion for the quarter, the last for which we have complete financial reporting is the third quarter last year. Expect that it's gone up in the fourth quarter some, but 58 billion compared with a little over 41 billion in the year prior. So yay, it's up. But a couple of points here. One, it compares in 2019 pre-pandemic to a pace of over 70 billion per quarter through the entire year. If we actually went back to 2015 and adjust for price inflation, it's close to 100 billion at that point. So it really is down substantially compared to these historical benchmarks. The other is cost escalation. If we look at the Bureau of Labor Statistics tracking of oil and gas extraction cost escalation, let's go back to September. So entering the fourth quarter and consistent with the end of this quarter here for the reporting, oil and gas extraction was up over 40% year on year at that point. And it may have backslid a little bit in the fourth quarter along with some of the oil prices, but it's still up enough where if you're spending more, you're not necessarily getting more for your dollar here. So how far that actually goes on an inflation adjusted basis from a producer price inflation basis is really quite consequential in an environment where services and the margins back in them for oil services have really shifted over the last year. In terms of the backlogs of projects, we track LNG export facilities, so liquefaction terminals, petrochemical expansions like you've seen in Pennsylvania, Ohio, refinery expansions and pipelines, storage facilities. The good news is this jumped a lot in the last quarter. So $218 billion worth currently under construction in the United States, up from $158 billion in the prior quarter. So this says there's been a pent-up demand to expand these projects. Between that the Inflation Reduction Act. I mean, there's a need to, and the international situation for natural gas, a need to move a lot of these things forward. Financing them, moving it forward. These are all ones under construction, so the affirmative final investment decisions have been taken. It's a good sign, but now there are, to the extent these are localized on the Gulf Coast, more inflationary concerns, because just simultaneously trying to execute large capital projects, multi-billion-dollar capital projects like this, just a few of these projects on the Gulf Coast can consume substantially all of certain craft labor classes. So that labor supply becomes an issue, and it's been a broader issue for the industry in terms of being able to supply and drill. And we'll talk about it for drilling here, but also we'll circle back for Ohio later on and talk about what's happening with completions and drilled but uncompleted wells nationwide and in the state. Here we are. This is global drilling, US and international oil and gas, shown from Baker Hughes, compared with futures prices for Brent crude oil, so an international benchmark on a rolling basis for year ahead delivery. Historically, that futures price has been a really good leading indicator of where drilling activity could go, but you see since mid-2020 the gap that's opened up. The futures prices have come back just fine, but the drilling activity not so much. And out of the 4 categories that are broken out at the top as of December, US natural gas is the one that stands out, right? And I mentioned the story in the summary of how it has zoomed back. It is now over 20% higher than it was pre-pandemic, December 19 to December 2022. US oil drilling is still down 8% broadly. International oil drilling is down twice as much. So, and when we talk about EIA's forecasts in a minute, they're assuming that international oil drilling and other non-OPEC production. So they're not assuming much from OPEC, but they're assuming that Guyana and Norway and Canada and Brazil come up with a lot of incremental production to the tune of almost 1.5 million barrels per day of growth this year. Not clear where that's coming from based on this. And then international gas drilling is down even more. So this is a shortage of global gas, and it's also not clear where that's going to come from. In terms of economic expectations, before we shift back to oil markets and gas markets, this is on the left, the annual growth for the world on a market exchange rate basis. So using actual exchange rates, you see the history since 2018, the downturn in 2020, a long-term average of around 2.5% per year. On the heels of some $20 trillion worth of stimulus since the pandemic, last year was still above average actually. And then what's expected this year is slowing. And then the regional breakout is shown on the right, but really slowing, led by the US and by the European Union, a recovery in China, a recovery in developing Asia, broadly expected by the consensus this year and next year. This is important. So you see the historical averages for China and developing Asia. China is expected to continue to trail its historical average this year. That's point one. And point two is that developing Asia, which normally goes on the coattails of China, is actually expected to be above average now for the next 2 years and solid. So this says some substitution where maybe activity doesn't completely go back to China, but you move some of that chip manufacturing to Vietnam or Laos or Cambodia or other places. But the region as a whole is continuing to perform strongly. And net, this is not a change from the historical expectations for global economic growth, which have said that most of the growth was expected to be shouldered over the long run by especially emerging economies and developing Asia in particular. Let's zoom in on the leading economic indicators for the US on the left now and China on the right. Kind of tale of two different stories. The best leading indicator for the US, where 70% of our economy is measured as consumer spending or personal consumption expenditures, we can use the University of Michigan's Consumer Sentiment Index. And through much of last year, it slipped to some historic lows for that index. People last year, in the latter half of it, were saying that they felt worse about their economic prospects than at any point during the pandemic. And actually, outside of the double dip recession in the early 1980s, on par with that, almost at any point compared back to World War II. So these are, despite pretty good economic numbers, pretty bearish signs for how households were feeling as price inflation was going up as high as it has been. Now, notice the overlay here with the amount of spending growth that's expected. So the year-on-year change in consumer spending, again, the lion's share of economic growth for the US, expected to slow, but not actually contract here. So in terms of estimates through what it should have been through the end of 2022, it's still a slight growth. Now, where this goes, if we look at Bloomberg consensus estimates, this is where we see weakening over the next 2 to 3 quarters in their view. China, it's the opposite. They've already been at stall speed in terms of the economy, industrial production, in contrast to the US, where we measure things primarily on a spending basis or an expenditure basis. In China, the other way of doing GDP accounting is to add up the value added by different industries, and industrial production is their main metric for measuring their economic growth. In their view, it's expected to bounce now. And keep in mind, with the easing of the zero COVID policy, infusing liquidity into the real estate sector there to try to stabilize things, they're trying to stimulate domestic economic activity and spending. They've had a wave of COVID, and it seems like an overwhelming wave where a lot of the population has contracted it early this year. But there's an expectation that because of that slug of people getting it all at once, that maybe they'll recover faster as the year goes on. Hence, we've had financial market expectations in recent weeks that China could be more buoyant in terms of its growth this year, commodities demand with it, and you've seen some strength in commodities prices as a result of this. But this suggests, for indications coming into January, that their growth from both an industrial production and a broader economic standpoint could bounce in China. Now let's shift to oil markets. I told you that oil demand goes with the economy. I'd like you to see it. So in this chart, the size of the global economy is what's on the horizontal axis, and the amount of global demand for oil is on the vertical axis from EIA's estimates here. And for 20 years, from 2000 to 2019, this is basically a linear relationship with even the great financial crisis in 2008 and 2009 was just a sawtooth on this scale. It was a very different business environment and price environment, but from a demand perspective, it was a mild setback. And look and see the unprecedented downturn as we shut down sectors of the economy in 2020 that really did affect oil demand for a period. And then you see the actual recovery from EIA's estimates in 2021, last year, what's expected for this year and expected for next year. So let's make 2 points. First, left to right on this scale. Think back to after the great financial crisis, how brutally the Obama administration, was criticized for the slow but steady recovery of the US economy, right? Well, here on the heels of that $20 trillion of stimulus I mentioned, within 1 year, after the 2020 COVID-19 recession, within 1 year, the global economy was larger than it was pre-pandemic. That's what $20 trillion does. That's what central bank coordination around the world does. We should have expected a lot of price inflation by juicing the economy that much, that fast. That's what happened. Policymakers, and you saw Janet Yellen's headline last year, if I was wrong about price inflation, but even Jerome Powell, who's a lawyer by background, not an economist, based on his public statements for a long time, didn't believe that there was an inflationary response to come with expanding the monetary supply, because empirically they hadn't seen it for a long time. Well, you can't defy the laws of economics forever. And we've seen now this inflationary response together with supply chain bottlenecks that have continued to impede the recovery. So that's point one, left to right, that the economy recovered and is expected to continue to recover now globally, at a little under 2% for the consensus view for this year of growth, and then close to long-term average or slightly above next year. Vertically on this, notice the point is that we're getting to record demand for oil globally by 2024. These are the official views of this. And again, EIA compared with IEA, EIA has the weaker view, only 1.1 million barrels per day of growth this year, compared with closer to 2 million barrels per day for IEA's growth for this year. So if the IEA is right here, this is the more conservative view, that taking the lesser numbers from EIA. Let's look now at the supply to go with this. This is EIA's view. We've got historically plus the estimates, the 1.1 million barrels per day of growth in supply this year, expected 1 million barrels per day of growth out of the US compared with, again, the hard to break out from 12 million barrels per day of crude production that we talked about. The 1.4 million barrels per day of growth from the other non-OPEC nations. So this is some growth out of Guyana, Brazil, Norway, Canada, Colombia. That's the lion's share of it. Not clear, given that drilling activity among these nations is still down, exactly how this will play out. OPEC not expected to do much in their view here. One of the key things that could play out better is they're expecting 1.5 million barrels per day lost from Russia. And this is the thing we didn't talk about, right? That the headwinds to supply, OPEC cut 2 million barrels per day of production effective last November. The additional G7 Russian price cap sanctions on Russia took effect for crude oil in December. They take effect next month in February for refined products. Many consultant views expect that to remove this 1.5 million barrels per day of Russian supplies, because it's really hard now for Russia to find additional markets. They're not going to be able to ship things to Europe or on European ships or European insured ships. They're going to have it's upending all the logistics for global crude trade. A lot of this tends to be fungible where it can find other markets, but Russia is now competing. The one place they can place product in crude oil is into Asia Pacific. That's also the market that OPEC nations for the long term most want to supply. It's a premium market historically. It's a market with the strongest demand growth. For the long term, it's one where OPEC has been investing in strategic relationships into refineries and petchem facilities in India, China, and other places in the region. And now here's Russia deeply discounting to try to take market share, the only place they can find a market for it. So that has many consultants expecting that Russia's not going to be able to find additional market and force people to not take those OPEC supplies this year. And hence, they think that will reduce refinery runs and result in less production coming out of Russia and being placed into those markets. By 2024, though, notice that the demand growth that we talked about, supply growth not exactly meeting that, but still coming back. OPEC dialing up a little bit more supply, Russia still remaining flat in their view, but then the US and other non-OPEC nations easing in terms of the amount of supply growth that they can bring. This is interesting. And the way to read this is to say that if this happens in EIA's view, that's what's required to balance markets. If it doesn't, then their price view and their balanced market view doesn't come to fruition. Let's zoom in on the US on the demand side. We match high frequency indicators across different segments with the fuels and then add EIA's estimates out to the end of 2024 here. First off, whether we're looking at flight activity, passenger activity for air travel, manufacturing activity, good year last year, vehicle miles traveled continued to recover along with the economy. Trucking markets were up a lot year on year, but it's sort of a tale of two halves of the year, where the first half of the year, trucking markets were tight and then loosened over the latter half of the year. Some of that was due to the fact that with the recovery in air travel, it was clawing back air cargo back, the things that during the pandemic had started to go by truck more. But just look at the biofuel estimates for demand out this year and next from EIA and ask yourself if that looks like a recession or a downturn. It surely doesn't look like what we saw during the pandemic. It's actually quite solid and close to record levels and solid growth for this and next year in EIA's view here. So that says we need more, not less. Let's talk about rig productivity, and Ohio's in the Appalachian region for dry gas production shown on the right. But I mentioned at the outset about 20% down in terms of if you run a rig for a month, how much oil and gas do you get by EIA's estimates? Down about 20% on average across December 2022 compared with the prior year across the oil producing basins, and it's more like 15% year on year down for Appalachia and the Haynesville. That's important because it says other things being equal, I've got to have more rig activity going just to get the same production. Now let's talk about drilled but uncompleted wells. Here's a stat for you. In 2021, almost 1 in 3, so 30% of wells that were completed in the United States in 2021 were from wells that were previously drilled but uncompleted. Almost 1 in 3, right? Last year, almost nothing. And in Appalachia, 0, meaning as of December that the amount of drilled but uncompleted wells, the inventory in Appalachia actually increased. It wasn't being drawn upon. So if you're drawing on a well that's been previously drilled but not completed, and now you bring that production in EIA's calculation of productivity, that's a tailwind to production, because without drilling, it's adding productive potential. What we're seeing are supply chain bottlenecks, workforce bottlenecks, where you're not getting wells completed here. There is no economic incentive to drill the well and just hold it off market outside of possibly the Haynesville area, where you might queue up a drilling program to go with the timed startup of an LNG export facility. But in the Bakken, in the Niobrara, and in Appalachia, that's not the case. And the prices have been, where if we compare to BTU analytics estimates of break-evens, you should be able to make money all day on average across every basin right now, whether we're talking oil or dry gas. So you should be bringing these if you can. It means that, and here's the negotiation, by the way, that if we came into last year, the only companies that really had a strong risk tolerance for drilling were private equity. So this is why Newborn and Endeavor and a lot of companies many people have not heard of led oil production growth in the US last year, while many of the major independents and global integrated companies were kind of left sitting on their hands as you got past Russia, Ukraine. At that time with Russia, Ukraine, you saw a spike in oil prices, loss of production globally, the global natural gas shortage, and everybody rushed to the service companies and said, I'd like to add some rigs, but they were sold out of high capacity rigs. And they said, well, I'll be glad to build a rig for you or refurbish one, but 3 things. One, it's going to cost 20 or 30% more than it did last year. It's going to take me 6 months to a year to build it for you. And you're going to pony up capital up front for this. And by the way, it's not a 1-year deal. I need you to sign for 1 to 3 years. And the risk tolerance then was really tested. So you've seen a lot of companies under the mantra or CEO speak of maintaining capital discipline, sort of hold the line and continue. And maybe they added a rig or 2, but they didn't add 5 or 10 rigs like they might have historically, because they're not available, they're really costly, and it means signing up for a long-term commitment at a time when we've seen a lot of variability in the commodity prices themselves. And note to self, early this year, as oil prices have pulled back, during the weeks they've pulled back, like in last week's report, we actually saw a drop of 10 oil rigs. This is the largest drop since September 2021. So small changes, even small pullbacks in oil prices, are translating into a pause in activity where people are skittish about committing forward here. So despite the fundamentals in the official forecasts and official agencies coming out and saying it looks like the world is short, the actual risk tolerance to move forward, to have the infrastructure to do it, to have the risk tolerance to move forward and make the service commitments, has not been there. So that's the disconnect between the market dynamics on one hand at a macro view, and really from a ground up, what companies have been financially and from a management standpoint actually willing to undertake. For Ohio specifically, if we talk about crude oil and natural gas prices, and keep in mind that going back to last summer, the Biden administration calling for the Federal Trade Commission to investigate price gouging for gasoline. If there was ever a red herring leading up to midterm elections and trying to politicize energy, it was that. Look at the blue line compared with, red is the Ohio regular gasoline price, the US average, in lockstep with that is the white line. Compare that to the blue one. This is on a monthly basis. Refiner acquisition cost of crude oil reported by EIA on a composite basis. These things go in lockstep. And if we do, I've been conservative in saying it this way, but first from EIA's view, straight up 58% of the price at the pump as of December was crude oil, like just on a per gallon basis of gasoline. If we do the year-to-year change on a US average basis, the current estimate for the US from last year was that just the change in crude oil accounted for 77% of the change in the gasoline price. So I said over 70%, it's actually 77. If you look at Ohio, it's actually close to substantially all of it, meaning there's nothing left over. it just is the change in crude oil that really has historically driven the change in gasoline prices here. So FTC, please investigate, but let's take the politics out of this and really, go back to, if you want affordable cushion and downward pressure on gasoline prices by administration, it really requires looking no further than understanding how to have a cushion for domestic oil production here. And the fact that we are still down 1 million barrels per day is against a geopolitical environment where we now have the lowest strategic petroleum reserves in almost 40 years. That's your answer. It's really that simple. In terms of Ohio, we can't break out Ohio specifically within the Midwest of different petroleum stocks, but I want you to see it for motor gasoline for the region, the Midwest region, the latest API and EIA data here, the distillate or diesel and heating oil inventories, and then propane and propylene, which are propane so important as a agribusiness, whether it's drying crops or keeping poultry alive through the winter. Basically looking pretty good here. And the distillate inventories have been a hot issue. We've had Secretary Granholm for months threatening to ban product exports from the US if that had occurred, because East Coast stocks were historically low. And East Coast stocks up and down for PAD 1 literally have been 40 to 50% of what they normally are over the last 5 years. And that's happened because there's been a global shortage of distillates, and we've seen a lot of this get exported. As a result of that, notice in the latest nationwide EIA data, we've caught up rapidly here too. Refiners have stepped up with high activity levels. We have 31.8 days of supply currently for distillates nationwide. That was as few as 25.4 days in mid-October. So it's caught up markedly, and it's about 2 weeks above the most that we've ever drawn down over any winter in the last 30 years, periods of 1 to 5 months. The most we've ever taken nationwide distillate stocks down is about 18 days worth. So that assumes that you can resupply and continue to supply, that there's not a disruption over that period, right? But it also says that we're in a pretty healthy position. We're in the 5-year range for the Midwest right now, rather solidly, and these stocks look good. I'm going to shift to natural gas quickly. Any questions on the oil section before I go to gas? Okay. So natural gas prices, they've come down a lot recently. The white area at the bottom is Henry Hub compared with international prices being multiples higher, whether we look at Asia, the Dutch benchmark, or the UK national balancing point. Wow, I mean, you see how high, if we went to the fall, we saw Dutch prices get as high as, on a monthly average basis, $70 per million BTU. That's over $400 per barrel oil equivalent prices. With those international prices being relatively higher, that's maximized the pull for US exports of natural gas, both via pipeline going to Canada and Mexico, as well as LNG exports, LNG ramping up as we've got some new terminals starting up and a resumption of exports from the Freeport facility. EIA's view of dry gas production versus different supplies. Net, the punchline here is that they expect continued growth of exports, some backing out of gas in the power sector. They also saw a lot of gas getting backed out of the power sector last year, and it didn't really happen. There was such a need for it. And part of that was that the normal coal gas substitution that you see across the region, coal prices, especially on the East Coast, followed global hydrocarbon prices last year. That pulled a lot of exports for coal to Europe and other places last year. Hence the crossover at times, and this is why we had natural gas prices at $8 and $9 per million BTU. The normal backing out, normal economics would be if gas gets above about $4 per million BTU, coal beats it, and then you just run coal as base load instead of natural gas at that point. That crossover with a shortage of coal wasn't working, and hence things were elevated last year. there's some assumption in EIA's view of a resumption toward normality. In their view, they have a lot more coal supplies coming on, but still coal getting backed out of the power sector this and next year. We'll see, because the coal shortage is continuing, and it's not clear also where that supply is going to come from. And hence, if that happens, then the backing out of gas to this point that they've got also may not happen. The one thing that is clear, and is probably right, is that renewables, wind and solar, will continue to make increased penetration into the power sector here. Now, for Appalachia, you're sitting with, whether we look at Dominion South Point or other Marcellus hubs, a discount of about $1 on a futures basis. I think the spot basis has been more like 80 cents per million BTU. The calendar 2023 estimates have been $1 below million BTU across the seasons for the year. That's where you're sitting, right? And in every producing area, it's normal to have a discount, but $1, that means you are stuffed from an infrastructure standpoint. You don't have enough pipelines, and pipeline constraints play both ways, right? So it's normal, if we're looking at Algonquin up in New York, New England, it's normal that they have a premium to Henry Hub here, 360 per million BTU over the calendar year. Iroquois Zone 2 over $3 per million BTU. California, also short gas, $1.40 roughly per million BTU premium. Sumas up in Pacific Northwest, about $1 premium to Henry Hub. Those things are normal. Florida gas transmission zone, 40 cents, 44 cents per million. All of these, except, by the way, the Blue Henry Hub estimate, are just differentials to Henry Hub. Now, as of the end of November, the estimate for the calendar year was Henry Hub of 579 per million BTU. If that plays out, that's historically a high number. We'll see if that recedes based on seasonality. These things always change. But the thing I want to draw your line to is just south of your area, Transco Zone 5, that red $1.91 per million BTU premium. This is a pipeline that goes from basically the Carolinas up through Virginia, right? Normally, that looks a lot more like Florida. It should be a 40 or 50 cent premium, but it's now a $2 premium in the Southeast, where you've had a lot of natural gas plants get put in. You mentioned at the outset, some of the banning of natural gas. Well, this is the region where you've had the most natural gas demand growth in the United States, right? More reliance on it. And because of the absence of the Mountain Valley Pipeline, which is 95% complete, it's tied up in litigation. Billions of dollars spent on it. That's 2 billion cubic feet of egress from Appalachia that can't get to this area. So on a calendar basis, you now have a $2 premium sitting there that's unprecedented. This makes the Southeast look like it's got the same kind of bottleneck as New York and New England. That needs to be fixed. So something with FERC interstate pipelines needs to give here, and it needs to be fixed. And not surprisingly, with the Nexus pipeline that goes from Ohio all the way up to Michigan, you have, that's been in service since I think late 2018. That has brought down the prices from Chicago all the way up through Michigan there, where you see discounts to Henry Hub now. A lot of gas on gas competition between Appalachia, Rockies coming east, and then Canadian gas coming down through mid-continent here. So well positioned, but Appalachia needs more markets. You need something, maybe LNG exports out of Philadelphia, if that facility from the Philadelphia Energy Solutions refinery, former one, can be completed, but definitely fixing the FERC permitting process to enable pipelines to move, because between Constitution, the Atlantic Coast Pipeline, and now Mountain Valley Pipeline, you've had 3 major attempts basically stuffed at trying to get pipelines out of Appalachia going south. It's really critical for your region. And lastly, the overall view, I mentioned that gas had caught up quickly. You see it here in terms of storage. This has helped bring the prices down recently. In EIA's view going forward, the prices are not quite normal. They're still elevated, but more normal than they were looking if we're comparing back a quarter or two in terms of the estimates. So that's the gas story. The key things I want you to take away from here, look, we expect to need more oil and gas globally, not less, as the economy continues to remain on track despite the diminished expectations. the headwinds in terms of productivity and what you can bring between cost escalation, lower productivity in the field in the US, the lower drilling activity globally for oil means where it comes from is a bit of uncertainty right now. We still have workforce and supply chain, financial and policy issues in the US that are real. The infrastructure issue is really important, and we need to get serious and take the politics out of this to address it. The issue du jour had been in the US, the distillate inventories you see, especially for your Midwest region in Ohio, that's come back strongly and it's in the 5-year range. Project execution, we talked about this, the projects under construction, coming back, the ability to execute that, to get rid of steel tariffs. It's not just about commodity prices and price inflation. It's really about keeping the energy revolution going, having petchem facilities that can be built in places like Pennsylvania and Ohio and moving forward. And lastly, just this uncertainty that looms of what it means to have the lowest strategic petroleum reserves in 40 years. And I don't know if it's more Russia-Ukraine. I don't know if it's a repeat of a Houthi missile affecting Saudi Arabia and the Abqaiq refinery facilities that we saw in September 2019. By the way, that removed 5 million barrels per day of productive capacity for a period, but it's not unheard of, right? We have in recent years precedents where this kind of thing happens. China, Taiwan, nuclear scaremongering, whether it's North Korea or Iran, whatever it is, if we have a strong strategic petroleum reserve and strong domestic production, that helps cushion American consumers. And it may not be in the industry's best interest to say, look, we should keep prices low, but that's the best thing for the economy. It's the best thing for American consumers, and it's the best predictable outcome for energy policy of what we should be pursuing. So that's the message, and I welcome any questions, anything that's on your mind, either for the state or anything that we've discussed here.
Okay, thank you, Dean, for that presentation, and I'm going to open it up for questions. If not, I have one that I was looking at. When you were talking about crude oil and you were talking about the demand in crude oil for motor transportation. And I know there's been a big push for solar, for electric cars, and we've seen a lot of these natural gas power plants come on board. You would think that, I guess, the dependence on crude oil for motor cars I expected to see a dip already. Are you predicting a dip with that demand for petroleum and just?
So you see EIA's view, right? Their projections or forecasts continue to show 0.7 to 0.9 over the next 2 years petroleum demand growth overall. Now, some of that is going into materials. So the red section that we didn't really talk about, but naphtha, gas, oil, propane, propylene, things that are going into refining and petrochemical sectors that are quietly about 27%, more than a quarter of US petroleum demand have continued to grow. They see gasoline, and this year gasoline was down slightly, not much. I mean, low single digit percent down. We've continued to see recovery in urban areas. So as the economy reopened, people have come back, and a substitution of people coming then out of the rural areas as much. And we measure this by either reformulated gasoline that's consumed in urban areas versus conventional gasoline in more of the rural areas. Net, this tells us, though, the other thing that was remarkable this year in our high frequency data was that the amount of seasonality was muted. So this tells us that we've seen more essential driving and less discretionary driving. And part of that was a function of the high prices that we had last summer. And then the effects of broader price inflation and more tight budgets for consumers going into year end. That all jives with the economic story. Electrification, and I think we've seen an all-time high now for electric vehicle sales, but it's really around the margins that's eating into petroleum demand, because you're now, out of all vehicle sales, only 20% are new vehicles, and only 10% of those or less are EVs. There's an issue, a pent-up one, just like we talked about food, in terms of vehicle affordability, though. So I understand from my counterparts in the auto sector that late last year, the average price of a new vehicle eclipsed $48,000. It's never been higher. This is happening partly because EVs, the average price of those is higher, And because for the internal combustion engine vehicles and trucks that are being sold, that only fully equipped models are being what's made and sold. So to have an average price of $48,000, it's never been that high. If we go back a couple of years, it was in the low $30,000 range, right? And this means that you don't have enough when only 20% of sales and 80 versus 80 being used car sales. This means we don't have enough secondary market supply of affordable vehicles. This is a pent-up problem for the next 1 to 3 years. We're making millions fewer vehicles than we were pre-pandemic and selling fewer as a result. This is partly a function of a chip shortage. Yeah, so how people afford these, and for EVs, there's a litany of issues from the recycling of the batteries, the affordability of replacing the battery when, for a Tesla, that's over $20,000. For the Chevy Bolt model, the litigation between LG and GM, $14,000 a vehicle. Anecdotal reports where Nissan doesn't want to be in the battery replacement business is forcing their consumers to go to third parties. And, frankly, if they don't want to replace the batteries and these become disposable consumer electronics, the entire life cycle emissions analysis that the policymakers are relying upon to say EVs are better from an emission standpoint is then wrong, because you can't just throw these things to the sideline and say, nope, with all the energy that goes into making these things, that they're superior. So if you have an EV compared with a hybrid vehicle, maybe with advanced fuel, 95 octane advanced fuel standards, low carbon fuel standards, suddenly it's actually on par. So what's more cost effective, the hybrid vehicle or the EV running at close to $50,000 per average? We'll see how those change. And the bet is that those will continue to go down market and grow. Consumer acceptance is an issue. If you're sitting in a cold state and you lose 30-40% of your range, that's an issue. Here in DC, Washington, DC area, you can get up to $19,000 of credit towards an EV. But if you tried to scale that up to everybody in the district, it's not affordable from a budget standpoint. So we're going through, and just like with wind and solar, on one hand, we're talking about technologies that ostensibly start to come down in cost to points where they should economically stand on their own. But yet, through the Inflation Reduction Act and other things, we codify subsidies forever, and the scalability of those and the rent seeking that goes on by different sectors, it just becomes very political about championing one technology over another, picking a winner and a loser, when economically we need least cost solutions. We need a price on carbon. We need international trading of emissions credits, things that enable markets to help solve these emissions problems that, frankly, I think the industry has come around to acknowledge are vitally important to address. But we need least cost solutions. As an economist, really, that's my bent for finding ways that we can get there.
Okay, thank you.
I
Absolutely.
have a related question. In regards to corn ethanol demand and soy diesel, biodiesel demand, how do you see this changing in the next few years? We have a lot of producers that market corn to ethanol plants, and soybean oil obviously being used for biodiesel. So this could affect their markets.
Absolutely. Great question. So, I mean, first, the food fuel debate that comes, is there in terms of corn productivity and all the things that we talked about in this environment. In terms of the industry and the politics around the ethanol blend wall and things like that, I think that's been sidelined for the most part. And you're seeing more alignment than there's ever been between ethanol and petroleum-based fuels, because they're realizing that liquid-based fuels helping enable energy efficient internal combustion engine vehicles is the future in competing against a pathway toward electrification. So if you're going to have an advanced fuel, low carbon fuel standard, it's probably going to be ethanol based, helping you get to 95 octane, for example. Now, the difference between renewable diesel and soy-based diesel in your question, renewable diesel is continuing to grow. It's supported by public support mechanisms, and chemically it's identical to petroleum-based diesel. So that continues to make penetration, and there have been strong incentives to shift higher cost or smaller petroleum-based units volumetrically into that, but you lose 80% of your volume in doing it. This is part of the loss of refinery capacity story that's played out in the US since 2018. Soy-based diesel and how far you can go in the penetration of that, a little bit different, right? So if it's not chemically identical, then you start getting limits in terms of how much of that you can put into the diesel mix. But again, there's plenty of market for it today, and there's upside for it. So I think from an agricultural growth into liquid-based fuels, the opportunity is there like it hasn't been in many years. And we need to continue to see that grow. At the same time that right now, at least for the short term, we're seeing liquid fuel demand growth by official forecasts. Longer term, maybe there'll be more fighting over the shares of the pie. But right now, with the uncertainties over the affordability of electric vehicles and consumer acceptance of them, the lack of any recycling technology for lithium-ion batteries, there are a lot of questions from a policy perspective where the cart has gotten kind of ahead of the proverbial horse here. So again, we have members that are championing electrification, electric vehicles. We're agnostic. We're fans of technology, and we want to see this go, but we just want to see it on a market basis where each fuel has the ability to compete on its own merits. Thanks, Mark.
Thank you.
Other questions?
Okay, well, thank you so much, Dean.
Thank you.
Absolutely.
Yeah, it was
There's
a
so
wonderful
much
presentation.
information.
Yeah, we'll be glad to share the slides. By the way, at api.org, I didn't mention it, but and depending on whether you're looking on a phone or through a computer, in the upper right hand, there'll either be a drop-down menu or an explicit link to the chief economist section. So this presentation, the monthly statistical report I mentioned, articles that I write, all of that's freely available on the website. And please feel free to reach out, through Todd, through Chris, any of the API folks for support on questions, anything we can do to help you.